Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss negotiating strategies and tariffs, trade war and interest rates, target date funds upon retirement, and a look at the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we? We're on the other side of tax season.
On the other side of tax season, yep, it's a big relief. And, I'm doing great. Both of my kids had a big weekend. My daughter's acrobatic cheer team won at a big event in Vegas. And then my son's high school went to the Worlds in Houston. And out of the 600 teams that qualified, they got second by the smallest of margin, too. I mean, so close to winning it all. So obviously, him being a senior, this was the big send-off that he was hoping for, since he's been really involved in, not just building the robots and all of that, but running the team this year as one of the senior leaders. So that was really exciting.
That is. I'm glad to hear it. That's awesome. Thanks for sharing that wonderful news. Well, let's dive right in. Of course, some very pertinent hot button topics here that people are wondering about, negotiating strategies and tariffs. There's been a lot of research time and money dedicated to testing negotiating strategies. I wonder if the news kind of dictates, or at least what we're able to gather, that some of that research time and strategy that's gone into it has just been thrown out the window. But there is a lot that is going on right now concerning negotiating strategies and tariffs. So let's dive right in. Where do we want to start? Artificial intelligence?
Yeah, well, I think with negotiating strategies, obviously the question is, what exactly is the strategy that the U.S. is using? But I think we could look at the research on negotiating strategies to get an idea of what our foreign counterparties' strategy may be. And these negotiating strategies are pretty interesting. There's been these competitions where teams can submit a negotiation strategy, and they run simulations and rank and see which does the best. And what's interesting, as you said, in this world of burgeoning AI intelligence, you'd think there'd be pretty complex strategy that would end up winning. But historically, what's interesting is really the most basic model, which is the tit for tat model, has originally or historically been the winner. So basically, the idea is with a tit for tat model, it involves starting out by seeking to cooperate with an opponent, but then if an opponent chooses to compete, you basically match that strategy, right? So if they compete, you compete. If they switch back to cooperating, then you switch back to cooperation. And of course, if they stay at that cooperation level, then you stay at that cooperation level, and you get that positive equilibrium. On the other hand, if they refuse to cooperate by competing, trying to take advantage, right, you have to be willing to compete to keep them honest. So really the idea and kind of what we're seeing playing out, right, is to some degree that tit for tat strategy that we impose tariffs. Okay, then they match them or even increase them, and then we respond in kind and so on. But what's interesting is within the tit for tat, there's actually a new and slightly better model that emerged. And this could be thought of as the model that assumes the best intentions of a counterparty. So basically, it is very similar to the tit for tat strategy, but what it does is it favors cooperating. So even after a counterparty switches to competition, the model will continue to seek cooperation until the counterparty competes for an additional round or shows a propensity to compete, at which point it reverts to the tit for tat strategy. So, really the most optimum model is even when a counterparty wants to, compete or negotiate hard, drive a hard bargain, is to, be more charitable, say, okay, maybe we can accommodate that. But then if they persist, that obviously there comes that point where it's most optimal to push back.
Yeah, it seems to me that from what I'm being able to get educated on, as far as it seems that when it comes to U.S. Negotiations, that the primary challenging one repeatedly seems to be U.S. China. Um, and it's pretty tough. I mean, the desire, tell me if I'm on target here, is to reach a nice equilibrium of things in that cooperative process.
Well, that's what you would hope. Yeah. I mean, really, a lot of what China's engaged in is what we would call beggar thy neighbor trade policies, right?
Hmm.
Where it's you're trying to enrich yourself off of your neighbors through trade strategy, where you'll come out ahead, and that can be done a number of different ways. You can have tariffs. Obviously, you can have restrictions just on companies' ability to enter your market. You can have full on bans. So as we've seen with China, there's been tariffs, that they've used to, argue, they would argue, try to protect, smaller industries, right, infant industries, while so they can build themselves up. They've also used restrictions where if U.S. companies want to go into China, they have to have a foreign partner. And in many cases, that involves sharing technology and trade secrets and things. So obviously, that's a pretty big barrier. And then even in some cases, full on bans, right? I mean, there's been the talk about how TikTok is allowed here in the US, but, Meta, Facebook and Instagram and all of those are banned in China. So that's another form of trade barrier. So what we're seeing is, where do you find an equilibrium when it's really more complex than just the tariff rate? And I think the concern is, with the current trade strategy that we're seeing, it doesn't appear to be trying to find a new equilibrium, right? It's just, in a way, it's that tit for tat strategy of just if they respond, we respond, and that when they respond, we respond. And so, game theory would tell us that that's our trading partner's optimal strategy is to continue to retaliate to any increase in tariffs or trade barriers that we may put up, which unfortunately means the trade war, may continue for quite some time, creating this ongoing uncertainty for the global economy.
Yeah. Well, as you state, theoretically, there is no endpoint for it. That it could just keep going. There isn't a part of this game that plays out where it's just like, yeah, here you go. You've passed go enough times.
Yeah, I mean, assuming a country wouldn't subsidize another country, right? The logical low end of tariffs is zero, is just free
Mm.
trade, which arguably would also be the most optimal strategy in terms of benefiting both countries and the consumers and businesses of those countries. Maybe not entirely equally, but it would be where they had the most optimal outcome, the best case scenario for each. But on the other end, trade wars or tariffs don't theoretically have a limit, right? The percentage can keep going up and up. But from a practical standpoint, there is a limit, which is when the tariffs are so high, it's effectively a ban on foreign imports, right? When you just make them so expensive that it's unaffordable or does not make economic sense to continue to import. And that's a situation where, tariffs obviously are a tax, that tends to get passed through to consumers, not always one for one. There's a lot of factors that go into that, as we've discussed. So, let's say a 10 or 20% tariff may not directly result in a 10 or 20% increase in prices. It could be a lot less. But if that tariff gets so high that it just doesn't make economic sense to continue to trade, that in effect becomes a ban for all practical purposes, which could have much larger disruptions on trade than just a normal tariff increase. And I think that's the risk of, this equilibrium of a tit for tat strategy, potentially resulting in such high tariffs and that it becomes a ban and creates huge disruption and makes it very expensive for supply chains to continue to function, which can lead to all kinds of problems, right? You can have where industries cease to exist, or not just higher prices, but shortages, or possibly people resorting to black markets, and of course the potential for economic contraction as a part of that uncertainty.
Yeah. Well, I mean, it's really pretty interesting layers. I had come across something, and if you want to punch some holes in it, that there could end up being situations. Part of the rise is that maybe the country that, if we just take US, China, some of those goods, that then they would have to go through a secondary country, so to speak, before they hit us. So it creates kind of that multiplier effect on the cost of it for potential stuff. Or that approach of, if it does create a contracting economy, the potential opportunity for different countries, even the US, to step into that industry. But even then, still probably at a greater cost to the consumer.
Yeah, and in areas where if we even can, right? I mean, global supply chains, deal with access to a lot of different commodities, different inputs and things that not every country has, right? That's why we have the globalization that we do. Even it's one thing to look at just competitive advantage that a country may have in terms of being able to produce things, but then there's just certain realities of certain minerals only being located in certain places. Obviously, certain crops only grow well in certain places, right? So again, a high enough tariff, could effectively result in being a ban. And if there's a ban, then maybe it's not the end of the world if we can't get certain produce or things like that. But that is a big impact on people's standard of living to have restrictions on the variety that they're able to consume. But in other cases, when looking at like critical minerals and things, there just may not be a replacement.
Anything else you want to add before we jump into trade war and interest rates?
Well, I think this is something that we're going to, need to continue to really track. Yeah, it seems to be changing day by day. The strategy seems to be changing. What we're going to talk about in a minute, I think, is a big part of, some of the changes that we've seen recently. And I guess, what we can hope is that some of these issues are communicated effectively so that, the people in charge of these negotiations have a real understanding of the broader implications.
Yes, sir. All right, trade war and interest rates. Historically, stocks and bonds have complemented each other, and we've talked about this as they tend to offer steady returns via interest payments when stocks are trending upward, but often rally when stock prices fall. We're kind of in an interesting area right now. What is going on? How is the trade war affecting interest rates? And, we've seen what's been happening with the stock market. That's been pretty prominent headlines. But I'm not seeing bonds being talked about as much.
Yeah, not as much, and I think it's actually a bigger issue that really needs to be monitored. When the trade war started on April 2nd, we saw yields on the 10-year Treasury bond fall quite a bit and actually went below 4% for the first time in 6 months. I think what we were seeing is in essence the financial markets were pricing in a higher probability of a recession. And as a result, there was this flight to safety into government bonds, and that higher demand for government bonds, bid up the price, which means interest rates come down. That's typically what you see. That's partly why we design portfolios the way that we do, right? Is so that you have those bonds that are doing well when stocks are struggling. And it's also an important mechanism for the economy because it means when economic growth is faltering and stock values are down, then interest rates come down, and that can lead to new investment, right? It's less expensive to borrow. People might buy a house. Businesses might invest in new machinery or equipment or hiring because they can get lower cost access to capital. And that typically will create new growth that'll, allow the economy to, return to equilibrium and return back to a growth state. But what we've seen here that's really interesting is after that initial decline in interest rates, we saw them quickly reverse course and move to higher levels than they were even at before the trade war was announced on April 2nd. And so the question is, why are interest rates not continuing to decline even as the stock market appears to be pricing in a larger and larger probability of recession? And it appears that part of the reason is you have foreign governments that are striking back against the U.S. tariffs by selling their U.S. government bond assets, right? So they're basically divesting from the U.S. And what that does is if they're selling bonds, then they're, the value of those bonds will decrease, which means the interest rates go up. And so you're seeing kind of the opposite effect. We've also seen some impact on the value of the dollar because, if they're selling government bonds and then trading those dollars for their own currency, then, that could also put downward pressure on the dollar. So it creates this risk that we could see slower economic growth and possibly the economy entering a recession as a result of the tariffs, while at the same time interest rates are rising, which will make it even more difficult for the economy to, return to growth. So it's kind of a negative situation of slower U.S. growth, higher inflation, and higher interest rates, all of which, will have different negative implications throughout the economy.
Yeah, let's dig into some of those negative implications if we could. But first, kind of a refresher, not just for me, but maybe the listener as well. What does the U.S. do with the money they receive from the bonds that they issue and are purchased?
Yeah, well, so we have a trade deficit, right? That's a lot of what's been focused on with the tariffs and the trade war. Well, the mirror image of a trade deficit is a current account surplus. Current account means larger money flows from abroad, more money coming into the U.S. Than is flowing out. And that's how you create the overall balance. So the way to look at it is as we buy, more goods from another country than they buy from us, they're receiving, excess US dollars. And what we find is they have a tendency to reinvest those dollars in the US. A lot of foreign countries own a lot of US government bonds. But also that money could go into Silicon Valley startups or, other types of investments as well. That has been historically a benefit for the U.S. Well, if there's trade barriers, so the trade deficit decreases, well, that means we're also likely to see the current account surplus decrease, which means less dollars invested here in the U.S. or, as what we've seen recently, even those dollars potentially exiting the U.S. and then being converted into their home source currency. So it's taken away, an important funding mechanism that the U.S. has benefited from.
Okay. Thank you for the clarity. Do you want to add anything else here before we jump to target date funds upon retirement?
Well, I think things seem to have kind of moderated a little bit recently, but this is something we really need to track. I think it's even a bigger issue than what we're seeing happening in stock market indices. And I think, the increase in interest rates is a big part of what has caused the White House to pause, a lot of the tariffs that were getting ready to go in place. Now, I know, as you said, this hasn't been reported on a lot, but it has a little bit. And they've kind of outlined this nightmare scenario. But I think the other thing to realize is there is somewhat of a symbiotic relationship. If these foreign countries, dump U.S. investments too quickly, they're going to push down the value of those investments. So, that would be bad for us, but it would also be bad for them because now their foreign reserves are worth less. Or the other way to look at it is they may very well end up selling us back our debt at a discount. And too much selling too quickly, as with any asset, right? If you have a founder of a company that owns a lot of the stock, they obviously can only sell so much at a time, right? There's only so many buyers out there. If they try to dump their shares too quickly, it'll have a negative impact on the shares, and therefore all of those shares that they still hold will be worth much less. It could have a real negative impact on their overall net worth. So there is an incentive for foreign countries to not be too aggressive in their divesting from the U.S. And given that things seem to have kind of moderated or normalized recently, it may have just been that they were sending a signal of what is possible with the selling of U.S. Treasuries that we saw there for a week or so. But maybe also realize that a lose-lose situation is not necessarily in their interest, just as it's not in ours.
Yeah. All right. Target date funds upon retirement. Target date funds can be a useful investment strategy during one's retirement. We've talked about this before, but the general objective of a target date fund is to match the investor's retirement date with the corresponding target date year of the fund. We've talked about dates and ages when this needs to happen. I mean, it sounds simple, but it's not always the case.
Yeah, I mean, these can be good tools. They're very common investment options within 401k plans. And, as we've talked about in the past, the accumulation phase when you're saving for retirement is, it's the much easier process, right? If you're disciplined, if you continue to put money away, if you don't, get scared when the market goes down and reduce risk or stop making contributions, right? If you continue to buy when it's down, especially when you have a long time horizon until retirement, chances are you will be successful. At least that's what history tells us. But once you get to the point where you're getting close to retirement or in retirement, investment becomes a lot more challenging because it's less about accumulation and rate of return, and it's more about risk management. And that's where these target date funds I think should really be reassessed, right? Because the funds typically remain fairly stagnant and conservative in retirement, which has a few problems. I mean, one, will it produce a high enough rate of return to be able to fund a retiree's needs? Two, does it accurately reflect the retiree's individual situation, right? I mean, I've had a number of cases where someone's retiring earlier than normal, or possibly even later. Maybe they continue to work and they retire later. Well, obviously, that fund, that given target date is kind of set up for someone maybe retiring at age 65 and might not be the right fit for someone retiring at 62 or retiring at 70, because it's really a kind of one size fits all, generic investment strategy that might not be the right fit for a given individual that has other resources such as pensions or maybe large Social Security amount, or retires at a different time, or has outside assets that are not being incorporated.
Yeah, let's dive into some of those potential ramifications of the earlier or late retiree than maybe what was initially planned out. I'm assuming the biggest ramifications from all we've discussed here on the Plan Solutions Incorporated podcast surrounds tax ramifications.
It can be tax ramifications. I mean, that can really depend on the type of fund, right? If it's in a 401k or an IRA, then probably doesn't necessarily change the impact a lot. But it does change the way in which you can implement withdrawal strategies, right? I mean, a time like now when the stock market is down, maybe you want to continue to hold those stocks till they recover, and instead sell lower risk investments like short-term bonds or that type of thing that are more likely to hold their value. But within a target date fund, because it's all wrapped into one fund, you really can't do that. You can only sell proportionally out of it. In the case of someone that retires early, they may need a little bit higher, risk profile, right? Because they have a longer potential retirement that they need to fund, or they may have a gap between when they retire and when they start drawing Social Security. Right. Or when they become eligible for Medicare, right? So they have a bigger gap early on that they need to be able to fund, where it would probably make sense to allocate some more conservative investments to cover those early year larger, expenses. So that if we go through a turbulent market, as we're dealing with now, then they're better in a position to be able to get through it without locking in any losses or taking as big of a hit. Whereas someone who retires later and sets up a target date fund, that may be more aggressive than what they need, right? Because it's assuming that they're younger, have a longer time horizon, a longer retirement to fund than they may have. They also may be getting more from Social Security or more from pensions than the average retiree because of those extra years of working. And they don't really need as much growth from their retirement funds to meet their needs, and could be subjected to excess volatility that is always a risk. If you continue to hold and don't need to sell, maybe it works out, but the problem is if you have someone in their early 70s who just retired and they're seeing a pretty high level of volatility in their investments, there's just the risk that they could end up saying, nope, can't take this anymore, reduce risk, lock in those losses, and then, not be in as good a position for retirement as they maybe otherwise would have been.
Yeah, so definitely that potential for that shifting of a budget as well, that always comes along with it.
Yeah, yeah. I mean, it could be budgeting, or it could be, that scenario where, okay, you reduce the risk and now your expected return is lower. And so then when are you going to go back to work? Because a
Mm.
retirement that, was set up for the long term, and planned pretty diligently, if you suddenly make a big change halfway through, doesn't, that equation maybe doesn't work anymore.
Yeah, yeah, I do know someone recently too that was kind of, lack of a better word, forced into early retirement. The company took a strategy, so there's lots of unpredictable scenarios that could come about. So it's just really mitigation.
Yeah, and flexibility. I mean, we always preach, and flexibility is so important because, the one thing we know is things will change, right? That we won't be able to dictate what all is going to happen in the future. So a one size fits all kind of cookie cutter approach, in many cases just doesn't offer that flexibility that may be needed.
Yes, sir. All right, let's jump on over to the Plan Solutions Incorporated office bulletin board. We've got one item pinned up there, Mr. Armour. What do we got?
Yeah, so I've been talking with a lot of people lately about investment strategies, and that some investment strategies you can use to alter risk in different and market environments, right? In an effort to preserve capital during difficult markets and try and take advantage of upward trending markets. We've talked recently about trend following and how long-term trend following can potentially be of use in this type of situation where if the market goes into a negative trend, you reduce risk. And then if it reverts back into an upward trend, right, then that's a sign, okay, maybe things are settling down and it's time to get back on track. But I think the challenge there is, really it requires getting the timing right twice.
Mm.
Right. So both you have to have the right timing of selling as well as the right timing of buying back in. And right now, I know a lot of people are interested in, okay, what can we do to reduce risk and preserve value given the uncertainty? And there are strategies that they can use, but the flip side of that is they need to make sure they're just as diligent about getting back in when the market returns into an upward trend, right? You have to have a system that you're using. Too often, it's easy to sell during a market decline because, it's just an easier emotional reaction, right, that triggers. But then when things settle down and maybe start moving back up, there's not necessarily that emotional trigger saying, oh, I gotta get back in. And too often, people then remain at that lower risk level for very long term, and end up missing out on the returns that they otherwise could have gotten, or maybe that they need to be able to fund retirement. So, historically, a good strategy has been to ride out these periods of volatility. But there are strategies, as long as it's a, very disciplined, detailed strategy like the long-term trend following that we've discussed. But people need to make sure they're just as diligent on both sides. If you can't be diligent about then moving back in when it's the right time or when the strategy dictates, then you're probably better off just riding out the volatility.
Yes, sir. Yes, sir. Anything else you want to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
Nope. Just, it's been a wild market. I've been through a lot of these in my 25 plus year career, right? So this isn't our first rodeo, as you say, but every time it's different and it brings up different challenges. And so, we are working diligently to look at what are the best strategies to be implemented. Fortunately, we had a lot of those tools in place coming into this. It's not like we're scrambling to try and reinvent the wheel. We already have those strategies in place and have been implementing them. But I think it'll be very interesting as we get some real data, right? I mean, so far, a lot of what we've seen has just really been about market sentiment or consumer sentiment, how people are feeling, which I think has some validity, but also, the hard data is really, the more accurate, the more valuable. And so it'll be interesting to see as that hard data flows in, what it's able to tell us.
Yeah, it seems to be one of the ever-present challenges, right? The difference between how people are feeling about it versus the actions they take.
Right. I mean, perception is not always reality, but sometimes it can be a good indication, right? And it is something to pay attention to. But yeah, sometimes it's not reality, and it may be more nuanced than what we're realizing. So it'll be very interesting to see how things progress.
Yes, sir. Absolutely. Well, we thank you all for listening to the Plan Solutions Incorporated podcast. If you're on Apple Podcasts, Spotify, whatever audio podcast platform, please hit a follow on there. And we'd appreciate if you share with someone else that'll get value out of the podcast, as we don't do any advertising. And if you'd prefer to follow along to a video form, well, you'll see the Personal Financial Review. We do have a YouTube channel, youtube.com/@plansolutions, where you can do so. And don't forget to subscribe to the Personal Financial Review. It's simple. Just send Katie an email. That's KATIE @plansolutions.com and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.